Happy Wednesday, everybody. Thank you for joining me today on one of my favorite webinars, which is talking about risk management in the note industry, really focusing on due diligence, how to manage your assets, and then also how to properly dispose of them. So before we get started, I will talk a little bit about the company, who we are, the offerings that we do have. So if this is your first time joining us, thank you. If you've been here on different webinars, I also thank you. One housekeeping item I will make for everybody is if you have questions, please put them in the Q&A and I will answer them either through the presentation, and we'll have time at the end as well for people to ask questions and get their questions answered. So first, a little bit about 7E. 7E is the brand. Our company operates under CWS Investments. I am based in Virginia. We're a mortgage note fund. We buy performing and non-performing mortgages and have an in-house team. And I can't strive that enough as we talk about management and due diligence, which I believe is, I think, our greatest differentiator, because it allows us to do that deep analysis to buy these assets at a discount, work through each loan in what we like to call creating win-win situations, where we can attempt to restructure deals with the borrowers to keep them in their homes while also, returning monies to our investors. And we have two offerings, a Regulation A plus and a Regulation D offering, which has the mission of democratizing these opportunities to allow them to be open to accredited and non-accredited investors, while also providing win-win solutions to borrowers. Yes, we will be recording this, and it will also, for people attending, it will be sent out to you. So first, let's talk about the Regulation A plus offering. As we mentioned, it's open to both accredited and non-accredited investors. There is a 4-year term for this investment strategy. Minimum investment, only $5,000. Bonus shares start at $25,000. I'll talk about those in a minute. And we have a preferred distribution at 8%, which can increase based on investment amount because of those bonus shares. So how do the bonus shares work? It starts at $25,000 investment, and you get 4% bonus. So each share is $10. So 2,500 shares times 4% is 100 extra shares. So your $25,000 gets you 2,600 shares, earning that extra distribution every month. And then when you go to cash out at the end, whenever that is, 4 years or hold it longer, those shares also get to be redeemed at the $10 price. So it's an extra $1,000. And as you can see, the more you invest, the more bonus shares you get. I just want to make a note because we do get this question asked. If you invest $30,000, that is 120 shares. So it's not just 100 shares within that pipeline or that investment range. It's 4% on that amount. And as you can see, again, it escalates up, which then can potentially enhance the targeted IRR. The other offering we have is a profit-sharing bond offering. This is only open to accredited investors. This offering has a 5-year hold period with a minimum investment of $100,000. And it's 5 years at 9.5% with 10% profit share, which we'll talk about. Or if it's a $500,000 investment, you can opt to just get a straight 11% coupon. In both of our offerings, we do not issue K1s, we issue 1099s, and both offerings do pay monthly, and funds can be from qualified and non-qualified accounts, meaning solo 401k, IRA, self-directed IRA. Those funds, we see a lot of investments come through like that. So here's an example of profit sharing, and again, illustrative purposes only. On a $100,000 investment, if when we go to issue these down the road, if there's $10 million in profits, profit sharing $1 million goes into the pool. That $100,000 investment would get your standard, 9.5%, which is 9,500. And then profit sharing would get an extra $4,000, which that year your payment would be, 13,500. So your return would, of course, increase if these numbers panned out like this. And as the company continues to move along, the company anticipates that it will grow and increase profits. So this is, designed, the way it was designed is for people who are interested more in a long-term investment opportunity where they can continue to grow that portfolio. And as I mentioned on these offerings, qualified or non-qualified accounts, payments are monthly. We talk about this a lot being a non-correlated asset class to the stock market. We look to seek up to 3 times collateral coverage and due diligence. We will talk about this. As of March, we had 70 assets in our portfolio. That has grown since that time in March. We have no management fees, and as we mentioned, tax forms are 1099s, not K1s. So now let's dive into acquisition and due diligence. Before we do, I just want to answer one other questions that mentioned, were we operating during COVID and what was the environment at that time, and did COVID have on the mortgage note industry? I'll answer that because that's a great question talking about our offerings. This offering was qualified in 2022. I was in the mortgage space during that time with prior offerings, and interestingly enough, during that time, we saw the greatest amount of payoffs we've ever seen. And most people would have thought, oh, your default rates would have gone up. They didn't. You can look at historical numbers, default rates, because of the forbearance plans the government had and everything else. But what happened during COVID? Interest rates dropped down to, people were getting mortgages in the twos, high twos, low threes. So if somebody's got a mortgage at 5-6%, what were they doing? Refinancing. We had a lot of borrowers refinance during that time. So it was a boom time for mortgage note investors because of a lot of the refinances and getting paid off. So I just wanted to answer that question as we dive into our due diligence. So we mentioned previously, early on, we have performing loans and non-performing loans. Let me just define them for people to make sure they have this understanding. Performing, it is what it sounds like. The borrower is making monthly payments and meeting their repayment obligations. These types of loans typically get purchased either at par or at a slight discount, depending on the interest rate that's currently on the loan. Another avenue of performing loans is short-term loans, potentially to real estate investors or other types of borrowers, still backed by real estate, typically higher interest rate, and you collect the interest on those payments. But in both instances, you have borrowers who are making the payments. Non-performing is the borrowers failed to meet those payment obligations or a contractual default. And most people think, well, what's a contractual default? Well, if the borrower wasn't paying their taxes or didn't have insurance anymore on the property, that is a default on the loan. It's not just the payments, there's other things. When you have a mortgage and a note that you sign up for, it's not only making the payments, there's other things that you have to follow. These loans are purchased at a discount off of the balance. And one question when I do these with Lauren that we always like to, go back and forth on is asking, what is the average delinquency on a loan? And most people think that if you miss a payment, the debt collector is going to come banging on your door and, start threatening you or whatever the case may be. That is not the case, or they shouldn't in any way, shape, or form. Most of the loans that we see are years behind. So it's not a borrower has missed 1 or 2 payments. They're several years behind on their payments. So we discussed performing and non-performing loans. And what are the steps to secure mortgage note? How do you buy a loan? It's very similar to buying a house, actually. The one difference is it's much less in it, let me rephrase this. It's informal compared to the formal process of buying a home. And I'll explain this right now is you get an Excel spreadsheet with information on it, and you just rely strictly on that information. So think about going on Redfin and just looking at a house on the information and putting an offer in. That's how you bid on a note. You're assuming the information is correct. You do what's called a preliminary bid. They accept it, reject it, they may counter. And then if it's agreed, then you have your due diligence period, which is like escrow on a home. This is when they send you what's called the collateral, which if it was a hard copy, it's a folder about this thick with all the loan information, the loan file, the application. Everything today, of course, is digital. So you get a big file with, a folder with about 100 files in it. That is the history of the loan. And we'll talk more about what that happens. After that period, which is about a 2-week period, you can fade the bid, which is reduce the price based on the information, or move forward. Then you close, you sign a contract, you close on it, and it's done. I have never met a buyer or seller of a loan in person to close a deal. Everything is 100% remote. So we just walked through the process of, what are those steps? So let's talk about, rewind it back to, bidding on an Excel spreadsheet, which we call a tape. And depending on the seller, some of them you have to use the term, quote, cherry pick, which is select the ones you want. Others, they call it AON, which is all or nothing. And we will take this Excel spreadsheet, we will run it through a model, and we will run it under different scenarios of if it's going to foreclose, if they repay, if they file bankruptcy, many different situations to engage, to review at what price point would it be worthwhile for that asset based on that exit strategy and the risk profile of that loan. And then we highlight them in different colors, just like, driving. Green is a go, red is no, stop, and yellow is proceed with caution. We got to do a little bit more research. So, and we look at all this information and, kind of start to, dive into what has been provided. Once it's accepted, we go through the due diligence period, which we call the 3 Ps: the person, the property, and the predicament. On the person side, we run what's called a skip trace, or you might hear the term LexisNexis. It's basically a public records search of the person. It can share their criminal history, their financial history of have they filed bankruptcy. And then we also review that folders, files we get that will show the payment history of the borrower, along with all the correspondence that they've had with the servicer, which is a company that manages the loan. So we put kind of a box on the person and, what are some of the red flags? Someone with significant criminal history, somebody who has filed bankruptcy 5 different times. So those are red flags to us that, based on past history, because we bought loans like that back in the day, are much more challenging and difficult to come to a resolution. So, everybody learns from experience, and from our experience, those aren't the types of borrowers we want. So we push them aside. Then the predicament, which is, looking at those files, what happened? You kind of ties with the person, but was it death? Was it divorce? Was it job loss? Was it situational of, what happened to cause them to stop paying? Somebody just didn't wake up one morning and say, I'm going to go get my cup of coffee and I'm going to just not pay my mortgage anymore. It's usually because of some type of life event. And is it something that can be recovered from? For example, job loss. If it's short term, it can be recovered. If situational, maybe a health issue that has now been resolved. Were they divorced now on their own and trying to determine can they afford the property or not? And then death, was it of a spouse or was it actually of this individual? If it's this individual, you're not going to probably get them paying. The state may come in and want to keep the house, but the predicament is probably one of the most important indicators of success in regards to can you work this out? And I saved the property for last because it's very important to understand. Most people just will look at a property and basically like, wow, that is awesome. And our case studies that we share today are informative because just because a property looks beautiful and has great value, it might pass one sniff test, but doesn't mean you fall in love with it and then ignore the person or the predicament or some of these other characteristics because the property is beautiful. So look at the value in the loan to make sure there's value in the property. We look at the lien position, meaning was it a first mortgage? Was it a second mortgage? We look at, the structure, the condition and structure, which go with the property. And the other component, which this was the hardest thing for me when I got in this business almost 10 years ago, to understand, because I, been in real estate for over 25 years, title. And what is clear title and all the issues that can go on with title. But clear title is simple terms. Do you have the ability to foreclose and collect your debt? Simple enough. So that's really what they mean by clear title. Mentioned early on, we look for equity coverage, meaning like 3x equity coverage. What does that mean? We like to buy loans that have been seasoned. If you look at a property 10 years ago versus today, what has happened over the last 10 years for real estate? Prices have shot up. Your mortgage goes down, prices go up. So that spread between how much you owe and how much it's worth typically continues to increase. So the older the loans, the more loan to value typically someone should have. So here's an example of a property that may have been worth 150,000 10 years ago. Today is worth 250. They owe 75% on the loan. They had a temporary job loss. They, haven't been able to pay. You can go step in, maybe buy that loan for 45, 50,000. Now your equity coverage or your investment to value, meaning how much money have we put into this investment compared to the property value, is significant. So if real estate prices, which we see today, are starting to come down a little bit, and in some areas they're getting hurt a little bit more, that $200,000 property comes down to 200,000. Now you're in the deal for 45 grand. So there's prices would have to drop significantly. These are the types of loans we like to target and focus on. Sometimes, yes, you may pay a little bit more because of that equity coverage, but it's not always about, that one component. It's also about that risk mitigation component. If you're paying this loan back, thank you, Mario. Somebody asked a question before I dive into legal standard. In this example, why would a bank sell this loan for 45,000? Wouldn't they be taking a huge loss? Yes, but the way I'll answer this question is banks are not built to manage debt. And there is in the United States something called fractional lending, which if you Google it and want to ever go down a rabbit hole, look into it. But banks can create money basically out of thin air with your deposits. And essentially, it's better for them to sell the loan at a loss than keep it on their books and then have to put the monies in reserves and not be allowed to lend. So I won't dive deep into it, but it's fractional lending, and it will blow your mind when you start understanding more about the mortgage space and so forth. So diving back into legal standing, we have an attorney in every state that reviews the title make sure that we have, again, that standing to collect the money owed. Perfect example that I'll share just came out, which I'm sure is going to get pushback or a fight. California just came out with a ruling that if it was a second position mortgage that had been either charged off or you weren't sending out the statements to the borrower, you can't foreclose on them. That's a new law and it's retroactive. So when we're going to buy a loan, we, try to stay up to date on every law, but we're in 40 plus states. There's stuff that comes through. This is why we have attorneys in every state that keeps us up to speed. Some of the common things that we see that impact legal standing is the note was lost. And a note is actually, think about like somebody signing a check over to you. And, so I'm just going to look, Brooke, who's the last name I see on here. Brooke, I'm going to write you a check for $1,000. Now, if you lose that check, you can't go cash that $1,000. The note is very similar that if somebody sells you a note and you lose it, you might not be able to collect that money. And the other component to that is what's called an allonge, which is basically the same thing as endorsing the check to somebody else. If they don't endorse it to you and it's typically done on a separate piece of paper or you don't have it, you don't own that loan. So possession's 9/10 of the law, as they say. So very important. Now there's ways you can still collect, but it depends on the state. And this is where you need an attorney to make sure you have the right documents. The mortgage, see this a lot. Title companies copy and paste when they're creating documents, the mortgage, the legal description. So we see periodically 123 Main Street is, the mortgage that we're buying. In the mortgage documents itself, it's listed for like 456 French Ave. So the mortgage doesn't line up. Big problem. Now, can it be fixed? Yes, but typically takes two things that people don't like to give up: time and money. Other standings, bankruptcy, Chapter 7, where a borrower can discharge the debt, and this term called a cram down. In Chapter 7, let's say, they owe Chris $100,000. They file Chapter 7 bankruptcy. They don't owe me the money anymore. So I can't collect another penny from them unless they sign back that they want to what's called reaffirm the debt. You still can go foreclose on the house, but you can't collect the money. Chapter 13 is where you restructure the payment plans. I'm not going to dive deep into bankruptcy. They're very complex, which is why you need an attorney, because most people are not bankruptcy experts. Last is statute of limitations, which vary by state. Here's an example of a property that we were looking at doing due diligence on, and they listed it as a second position note because there was a note from 2004 on file with the mortgage being recorded. We actually were able to find a copy of that note through some sleuthing, and the note matured in 2006, which the note actually ended up now being outside the statute of limitations, not collectible. The note we were buying that they're selling, think it was a second position, but it was a first position note. So our due diligence, without even just buying the loan, increased its value, 100-fold easily, because now we're in first position, not second position. Was non-performing. They thought they'd have to pay off that first, which was a $100,000 loan. Didn't have to. Good attorneys can make or break, in managing your attorneys, make or break the outcome of a loan. So we talked about some of those processes and things that can go right, things that can go wrong. How do you manage this process? So let's talk a little bit about the legal process. And it's not for the faint of heart. And what I mean by that is non-performing notes is a conflict-oriented business that, it's contentious. At times, now you don't have to typically deal directly with the borrower, but it's still, correspondence back and forth between the services and stuff trying to work out a resolution. The way we have found in our experience, the best way to streamline this process is by actually engaging the attorney. Send a demand letter because they've gotten so many letters from the servicer that now that says from the law offices of Brian, that gets somebody, out of bed or somebody opens up a piece of mail. Once they get that, they typically will communicate through the servicer. And typically the first question is, how do I save my house? What do I need to do? So when you send that, you should already have planned, okay, what are some of the options that we have that can, work? And we typically do what's called a trial payment plan. Think of it as a payment plan on training wheels. Because if you modify that loan and bring it current, you have to wait months before they go back into default, and potentially if foreclosure was already started, start the whole process over and pay all the costs of foreclosure, which isn't cheap. Trial payment plan is like putting pause on everything that's going on. So it's like, okay, we're going to pause this, put it aside, and give you this new payment plan. And if you can make it and follow this and abide by this for 3 months, 6 months, a year, whatever the case may be, then we'll modify the loan, bring it current. Then at that point in time, we'll collect payments for another 6, 12 months. Then we'll turn around and sell it back on the market as a performing loan at 80 cents on the dollar. Now, if the borrower files bankruptcy, that's going to delay the process because interesting enough, bankruptcy is federal, but it's broken by regions within every state, and every region with every state operates differently. The northern region of Ohio does not operate the same way the southern region of Ohio does, which blows my mind. So I mentioned Chapter 7, the borrower either wants to, typically they want to abandon the property and do what's called the deed in lieu of foreclosure, give you the keys to the property, they walk away, and that's it. Some instances, if they want to keep it, they have to re-sign the agreement, the affirmation agreement, which again attaches the debt back to their name. Chapter 13 is what's more common. It's a restructuring plan. Somebody goes and has 50,000 on credit cards, went and bought a $50,000 car that's paying $1,000 a month, and the mortgage payment's $2,000 a month, and all of a sudden they realize, wow, I'm $3,500 a month. My taxes, my insurance, everything's gone up. I can't afford this. How can I restructure it? So they file bankruptcy, and it's a 5-year plan that restructures their payments, and it breaks down secured, unsecured. All you need to know is if you have a first position mortgage, you're going to get all the money that's owed to you during the plan if they make the payments. Credit card companies, they may take a haircut. Second mortgages potentially could take a haircut. First position mortgages, that's why we love first, because in this instance, you're what's called secured. So we talked about, sending the demand letter, bankruptcies, this whole process of managing and kind of the trials and tribulations of, going through with the servicer and the story of, working with these borrowers and, think about, if you go back, people, went to college back in the day and so forth, and, all the crazy stories from there, it's very similar, crazy stories from all these borrowers. That gives a lot of education experience. That education experience leads to how do you exit these loans? What's the best way to go down this path? It's 2 paths that we start with. Path 1, through the borrower. What does that mean? You sell the loan on the secondary market. So we sell it off to somebody else. The borrower may pay us off or, through either a refinance, or they may take a short payoff. We've had borrowers, they owe 100,000, said, hey, I can get $80,000, next week. Yes, we'll take it, in some instances. The other is through the property, which is foreclosure. They sell it, or they hand you the keys, what's called the deed in lieu of foreclosure. We'll talk a little bit more about these, but these are really the 2 main exit strategies that you can go through on the borrower. I'm just going to pop back this. And to give you timing on these, it really varies on the state. There's judicial states and non-judicial. Non-judicial foreclosure process and everything is quicker than a judicial state. Through the borrower typically is a 12 to 18 month time frame between the two. During COVID, somebody asked that question. You were a very high chance you're going to go through, and I'm just that top phase of through the borrower. Today, it's still through the borrower, but you're seeing more through the property because people may have bought their loans during 2020s, or they may have modified loans or missed a lot of payments where that balance just kept increasing and the property values have come down slightly. And they realize now, for anyone who's around back in 2008, 9, or 10, people getting 80/20 loans, they had no equity, either emotional into the property or sweat equity. So it was easy to walk away. You're seeing a little bit of that right now. I think FHA loans, which have the lowest down payments, are just peaked at 10%. But overall, you're at 2 to 3% overall within all of loans. So that's not a foreclosure crisis. Historically, you're at 3 to 5%. But on a volume level, 3% of a $16 trillion industry is $480 billion. So we're raising $75 million. There's $480 billion of non-performing debt out there. And of course, our entire portfolio is not non-performing. We like to balance it. Now we're going to dive into two case studies. First is one in Tulsa, Oklahoma, that was a non-performing loan. This one's, several years ago, we bought it at, about a 35% discount, 70% loan to value. Borrower was behind about 12 months. Initial outreach was unsuccessful. Have the attorney send a demand letter. Borrower steps up to the plate, was responsive in November. We worked out a trial payment plan with them where they would start making payments and mentioned, hey, I get a bonus, an annual bonus for my company in April. When I get it, I'll reinstate the loan. So that was written into the agreement that you'll make payments, this month, and then by April 30th, you have to bring the loan completely current. Borrower did that. Then May, June, July comes around. August keeps paying. October is actually October of 24. It's not October 25 yet. My apologies. They fell behind again. Then we've sent the attorney demand letter. This time the borrowers turned around, boom, completely reinstated. And at this point in time, the balance had kept coming down and down and down on the loan, which then we turned around and put it on the market for sale. And about 60 days later, borrower made those February, March, April, May payments. We sold this back out on the market. So in this instance, the borrower, was getting behind, but was getting that bonus. And we saw that in the file, still that LTV. So we were confident that we would be able to continue to work out some type of arrangement with this borrower. And there was no red flags of bankruptcies or anything along the lines. And you can see, the house, it's well maintained as well. So it wasn't, broken windows, smashed windows, grass 3 feet tall. It was, a well-kept house. The other I want to share is we passed on this. And first look, you look at this house and they're like, wow, that's a beautiful house. It's on a lake community and outside of Charlotte, North Carolina. It was a non-performing loan that come across our desk a year and a half ago. And just remember that. So early 2024, because today we're in, where are we? August 2025. Property was in great condition, had a great loan to value. The loan balance was $2 million on a $5.5 million home. So low loan to value, or maybe $4 million, it says here 60%. But when we started going through the paperwork, the borrower, this is, man, that's why you don't do business with friend. The borrower and a college friend who was an attorney had this LLC. And allegedly, the attorney friend was signing all the documents in the borrower's name without his knowledge. Now, there's a thing called power of attorney, which typically they sign as power of attorney and they give the power of attorney, but you don't sign that person's name. I don't sign Brian's name as an example. I still sign my name and it would say as power of attorney for. So allegedly, the attorney was doing this fraudulently and the loans were getting sold. So this turned into a title claim because the lender, was under the pretense of this person could sign. He had all the paperwork. The person who alleges that they weren't part of the signatory is like, hey, this is my house. I didn't authorize all this money, which somebody got, all the money, went somewhere. It's a hot mess on this one. And I actually looked this up yesterday. I'm like, whatever happened to that when I was preparing for this? This is still tied up in court a year and a half later. And I think the next hearing isn't until like February of next year. So this is probably going to go on, I'm guessing, for another 2, 3, 4 years based off of the size, the number of people involved. There's a former NFL player involved who actually was part of one of, there was another loan that was involved in this. I mean, again, people look at the property and basically, ooh, this is nice. Let me maybe I skim over some of these other things because I just want this property. Devil's in the details, people. Even though it has that equity in it, who knows what could happen? And in a title claim, who knows what you're going to get? And typically you can only get what was insured, which in this instance, all that other interest and everything that collects, might not be able to collect it. So huge risk, huge red flags on this loan that just really pop at you. So I love sharing this case study because, most people will look at properties that have broken windows, a hole in the roof, or, trash in the yard and think, okay, that's an easy pass. House that looks well maintained, well kept. Oh, this one's really down our pipeline. This is a good one. It's those 3 Ps. The property may be good, but the predicament of the person, complete red flags, and and vice versa. So last second, just really want to touch base on what sets us apart. And I mentioned it early on when we were talking. I believe it's that in-house management and in-house team, which is the last item on here. And I share this because here's another case study that I'll share. Literally just happened within the past 3 weeks. We just bought a loan from a non-performing loan. Person's behind. The borrower is behind because they took all their money and put it into this land deal that they have to get it entitled so they could turn around and sell it. Now they owe, I'm just going to make up some numbers here, $750,000 on this loan. We're in it for under $500,000 on a purchase. Hypothetical, rough numbers, but percentages are pretty close. This person has this piece of land for sale under contract for millions of dollars, and it's got, very little leverage on it. The company that owned it hired a third-party firm who had this information, but didn't put 2 and 2 together of, oh, wait, maybe we wait, or we work on an agreement with them that cross-collateralizes this other loan. So if, we go into default, then we also have this other loan cross-collateralized because it's in a separate, entity that they have. Things like that. This is the stuff our team, first thing pops in mind, oh, this is what we should do. Others don't think that. So in-house is so important. We also have the in-house investor relations team. So if you're an investor with us, you pick up the phone, you call someone, you're speaking to, one of us. I've had, an investor text me today, so forth, that unfortunately I couldn't take the call. I put them in touch with one of our team members got it resolved in 10 minutes. They had a question about one of our offerings. Simple. It's not somebody who doesn't know our offering or anything along those lines. So we mentioned also in one of our offerings, we have that potential profit sharing. We also mentioned we're non-correlated to the stock market. The risk-adjusted returns. What does that mean? We don't currently have any debt on our books. So I don't have a $10 million line of credit, or let me rephrase. We don't have a line of credit, but an example would be a multifamily property. Somebody buys a multifamily property, they're typically going to leverage at 60 to 70%, and the investors make up the 30%. Here, investors are 100%. And then for people interested, of course, it's that hands-off investing where you do all the work. You don't have to deal with the tenants, toilets, termites, any component of that. Also, our experience, we've done over 600 deals, valuations of those deals over 100 million. We've been in 40 states. Certain states we've learned we do not go back in. I joke sometimes, I've been that state twice. It was the first and last time I'll ever go to that state. We've had 5 prior offerings that went full cycle. I mentioned that vertically integrated team, those other funds that we've had. And again, I've been in real estate 25 plus years, been in the note space almost a decade now. So if people are interested, feel free to book a call with our team. Here's a QR code that I'll jump back to in a second. Or you can call us at 866-226-5736. Email us at invest@7einvestments.com. Go to our website, 7einvestments.com. Or like I said, scan the QR code. Let's see. Let me run through questions. Okay, someone asked regarding what are the go, no-go criteria you set when we mark loans red, yellow, and green? First, we start with state. So we'll start with what state is the property in? Alaska, Hawaii, New York, out, completely out. Cook County, Illinois, Cuyahoga County, Ohio, out. Oregon, Washington, out. So filter by state. That's the first thing. If it's in a state we don't want to do business in, that goes to red. Second, we look at property value. If it's under, a $75,000 property, not worth the time or effort, we'll put that to a red. Higher loan to value, depending on what the loan to value is, typically a yellow. If it's a low interest loan, maybe written at 4 or 5%, and the borrower is only 3 or 4 months behind, that's a red. Because in that instance, the seller's discount, they're not going to want to sell it at a much of a discount because it's not super far behind. But if the borrower files bankruptcy, you just bought yourself a 5% coupon note that, that was, if I wanted to make 5%, I'd go put money in a money market at, 4%. So yeah, there's multiple factors in that, but those are the primary ones for us. Where does one attain the model that you run your tape through? Great question, Steve. I don't know. I'm an engineer and a geek, and also, have a finance degree as well. I probably have spent, I don't know how many hundreds of hours fine-tuning that model. Each investor has their own. It's pretty much proprietary. We do give away a simplified version. Honestly, if I actually gave you our model, it would be probably like stepping into a 777 and trying to fly it. You'd see all these instruments and everything going on with it, and basically like, what does each one do, and not realize if you pressed one button, it could have a very big impact on your financial model. But reach out to us. We do provide a simplified model for people who are interested. Talked about why the bank would take the loss. We are back. What are your typical sources for tapes and loans? Great question. And it's interesting. I'm chuckling a little bit because a lot of gurus will tell you, oh, you've got to call banks. This is where you get all your loans. It's rare we buy from banks. Typically, it's firms that are called whole loan traders, which are M&A companies, merger and acquisition companies. We see, last week from just one company, there was $800 million in loans that came across the desk. Then another one at 20, another at 30, another at 20. We see over $1 billion easily a month in loans, mostly from 7 or 8 sources. You don't want one source, but you don't need 50 either. So, and I don't even believe there is 50 sources, but that's primarily where we get them from. We don't spend any time chasing banks. And the reality is, if a bank is selling loans, they don't know who to sell to. So they're just going to go call one of these trading companies anyways, because they have all of the due diligence done on vetted the proper buyers. The banks that we had spoken with long ago, their pricing, they wanted basically way too much for their loans because they don't typically sell loans. On average, how many notes do you tend to buy and sell each year? Oh, good question. I don't have the exact figures, but our fund is 3 years old. I believe we've had over 250 loans just within this fund. Either, not currently what we have, but, from buying and selling and, where we're looking at. Right now, on average, we're buying between $2 and $4 million a month is what we target. And that's in between some of the money coming in, as well as loans getting paid off and so forth. Someone mentioned my husband Steve looking forward to meeting me in September. Yes, I will be at a conference called the Paper Trail Conference, which is September 18th to 20th in Chandler, Arizona. So people are in the Arizona area or interested in meeting others within the space, that is a great opportunity there to connect with people. And again, you can go to website papertrailconference.com to learn more about that conference. How do we vet staff and who within your company has access to investor funds? Good question. We run background checks on our employees. We have audited financials. The investor funds process currently goes through an escrow company who will also do what's called AML KYC. Doesn't matter where the money comes in from, but so a few things. One is, for every investor, we do AML KYC, which is anti-money laundering, know your customer, to make sure we don't have some Mexican drug lord, filtering, $10 million to us, which we had somebody who was affiliated once with one and spent many years in prison wanting to know if we would do a sidecar deal for $5 million, believe it or not. And then from an employment standpoint, yes, we do checks on the employees. From the investor funds perspective, we use a third-party portal where investor information is provided. Any types of payments go through. Everything has to have a 2-step process. Within, meaning somebody puts in an invoice, then somebody else has to review and approve it. This was all part of required audited financials and some of the reporting processes, part of that we have in place. In terms of risk management, do you set guidelines that no single loan may represent X% of your portfolio? We do, and it's kind of a floating scale in regards to where that is. It's a little more than 2%. We look at more based off of where we're at with performing loans versus non-performing loans, is where I think the bigger focus is in regards to those items. But, when we go to buy our loans, we're always looking at, we don't want a significant high dollar number of loans. We also don't want a significant number of $25,000 or $50,000 loans. So we like to try and keep our average loan balance somewhere between kind of, say 300 and 600,000, which, I'll use the term is, average. So a house in Ohio may be very different than a house in California. So someone asked a question, which is a great one. If you invest a lower amount, then hit the bonus share to increase, do you get the bonus shares? Unfortunate answer is no. When we submitted to the SEC, which is where this had to get qualified through, they required every investment be treated as a separate investment. So we cannot combine them. It's similar if somebody also invested with a self-directed IRA and individually themselves. And that actually also comes into play because your IRA would be benefiting from a personal transaction, which is a prohibited transaction as well. So those are common questions that we get asked. Okay. Any other questions people have regarding 7E, the offering? How liquid is my investment? It is not. It's illiquid. It's a 4-year hold period. If somebody does need to redeem, there are penalties. There are no penalties for death and disability. This is outlined in the offering. We're happy to point you in the direction where it exists. But that is one thing that with these types of offerings, this is not currently is not a liquid investment that you can take out anytime. Once you hit the maturity date of that term, then it's considered liquid. You can take it out at any point in time. How many investors do we currently have? I believe we have over 800 investors currently in the fund. Are our funds separated by performing and non-performing? Once re-performing, do you move those? No, it is one fund. So we do not have a separate fund that, is buying and selling from one to the other or any types of affiliated kind of transactions or funds in that sense. In some of my prior funds, did we buy assets from those? Yes. And, went through that process. But currently, there's no cross affiliation in regards to, okay, if it's a non-performing, it's here. When it goes performing, we sell it over here. No, everything is, and even if you invest in the Reg A versus Reg D, it's just 2 entry points into the same fund. And I'll also note the fund owns all the assets. So there's no holding company that you're investing in a separate company that owns another company. You're investing in the company that owns all the assets. Does investment offer New York tax advantages? I hate this question because I can't provide tax advice. What I can share with my own personal experience is in the Regulation A, you are a shareholder, which is no different than owning shares of another company's stock, which typically has a different tax, a lower, tax rate than some, interest income would, which is typically taxed at ordinary income. So, but you have to hold the shares for a certain period of time. So, and if you invest at the end of the year, then at the year end, how does that play into account? There's a lot that goes into taxes in regards to each person's individual situation. For the Reg A, like I said, for both, people get different 1099s. There are no K1s though, which we get our reporting out by the end of January, so you know where you stand. Any fees listed or that are not already factored in. So there's no acquisition, disposition, management fee. I'm a salaried employee of the company. The people who work for us are employees as well. So I don't win until the investors, get their returns. So it's not a, hey, I'm making an acquisition fee on every single deal that goes into my pocket that, hey, if the deal, goes bad or whatnot, who cares? I already made my money. I'm collecting a salary and, profits from the company only come to me after all the investors receive their preferred returns. What are the pros and cons of a 1099 versus K1? I'll give you my own, again, personal experience. K1s are due the end of March. If you invest in a fund and get them by the end of March, that is winning to an extreme level. I just recently got one about 2 weeks ago, the last one I needed. K1s will cost you more typically. Well, for me, it costs me more to have my CPA, my accountant, do my taxes because I have K1s because again, I'm not a tax person. My wife is, but it costs more. 1099 is just a document like might get it from, shares you own of something or from the interest on your bank. You hand it in, it goes on a specific place in the form. It's much easier, in my mind, to get your taxes processed. And you're not chasing down the sponsor and having to file extensions and wait if you get a return till September, October to get your return to get your taxes done on time. Do you have a continuity plan if either you or Lauren unexpectedly leave 7E? Yes. So we have a continuity plan in place for short term, long term. Continuity plans are in place. Several years ago, when we entered the broker-dealer world, we got a report done by a company called Factorite, which unfortunately that report's not a public report. It's only available to, I think, broker-dealers. But we learned a lot from that and information in regards to putting together business continuity plans, having things like key person life insurance policy. So if I were to get proverbially hit by the bus tomorrow, there's an insurance policy the company has on me that covers, provides the company funds to have, but also, in that interim, bring somebody else on board. There's a whole, several different plans on that. Do investments offer any tax advantages or deferments? If you're thinking of like depreciation, along those lines, no. There's no depreciation because we are a lender. It's not we're not owning the asset, that we're collecting, bonus depreciation or anything along those lines. Another question, what percentage of your investors are invested with a self-directed IRA? Great question. I don't know the answer off the top of my head. Chris, we can get back to you. If I were to throw a dart at it, probably 25% plus. An area where a lot of self-directed IRA investors love these types of debt funds is back to the question I just answered about tax deferments. If you invest your self-directed IRA in a multifamily deal, as an example, some of the perks of that is that depreciation you can recapture. Self-directed IRA, you don't get any of that. So for example, for me personally, if I have cash, depending on where you're at, some people like put cash in those types of assets to get the depreciation, and self-directed and types of debt funds because they don't have that. But it's two very different investment strategies. This type of fund is an income play. You're looking for that monthly income coming in the door. Other types of offerings are more of an equity play where you might get a little bit of money throughout the investment, and then at the end you get the pop. How many 4 or 5 year cycles has the fund had in the past where investors went through full cycle from initial to redemption? What was the performance of those cycles? So the prior funds were varying in term. They were anywhere from One of them was Evergreen that had a 1 year minimum. That fund went for about 3 years. The other funds were about 2 to 3 years, and they had different, you know, they're structured, so some were similar, some were different. The overall performance based off of our third-party review, the investors had a 14.5% annual return. If you're interested, we can provide you with a copy of that third-party due diligence report. You can email invest@70investments.com, and we are happy to share the report on our prior offerings. As I mentioned, we did have that done by a third-party company that looked at it, so it wasn't, Chris, just putting stuff in an Excel spreadsheet and come up with numbers and saying, "Here you go." We provided all the information over to that third-party company. What is your fund's preferred return rate to investors? That varies depending on which investment you invest in. It's anywhere from 8 to 11%, depending on the investment and which offering. Okay, I think I was able to answer all the questions. Nobody has any other questions. I do want to thank you for joining us today. A copy of this webinar will be sent out to everyone who attended or anyone who registered, and we'll also get it online as well. Want to thank you all for coming on today, and look forward to speaking with you in the future. Thank you all. Take care.